took about a month ago, it was about 62 US cents, was buying one Australian dollar. It's now 70. It's a 12% move up in 1 month.
You've got a US government that is keen to have a weaker US dollar. Part of the reason for that is that a weaker US dollar makes American exports cheaper in the global market.
Question that the broader internet at large is really wondering, and that's why in the world we've seen such a strong move in the Aussie dollar versus the US dollar currency.
When it becomes such a mainstream indoctrination that is the only form of asset class you can go in, you know you're starting to move into a genuine speculative bubble.
Is there any way that the administration could influence currency markets, and how so?
The hot potato has been composition of the Fed, and it's been very clear that President Trump and Jerome Powell haven't been seeing eye to eye.
No,
they're not going to be on each other's Christmas.
Definitely not. Last week we saw a 30% decline in silver prices in 1 day.
Everyone has got a view, just buy silver. Just sitting on a pineapple is not much fun.
Worst day ever for silver on Friday. How do you hedge out or mitigate that risk?
The currency hedging is a great tool. Hey guys, a lot of conversation out there right now about exchange rates. Where's the Aussie dollar going? How does it affect you as an investor? And most importantly, what can you do about it? We're going to explore some of the factors that drive currency moves, but most importantly, we're also going to explore a couple of techniques that you could choose to use to help hedge out some of the risks that come alongside big swings in the currency. As always, don't just take notes, make sure you take action. We'll see you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Yeah, I'd love to say I'm happy to be here, but I keep getting stood up on the outfit changes here, even with the timepiece in the three-piece too. Very nice.
I feel like
Talk us through this before we start.
This is like Alice in Wonderland. We can time this one to perfection.
Monopoly Man almost.
Something like that, mate.
Very good. Now, AB, the topic of today's conversation is one we've had so many questions from clients, and it appears to be a question that the broader internet at large is really wondering, and that's why in the world we've seen such a strong move in the Aussie dollar versus the US dollar currency.
It's always interesting. Currencies are one of these areas you either get or you don't.
Yeah.
And so it's kind of like, once you understand it, it's a very logical process. And if you're looking in from the outside, it's this murky world of basis points, pips, and goodness knows what else. So let's make some sense of it.
Yeah, well, look, a bit of context for our listeners out there who maybe don't follow markets as keenly as we do. The Aussie dollar has gained a hell of a lot of strength relative to the US. So we took about a month ago, it was about 62 US cents, was buying one Australian dollar. It's now 70. It's a 12% move up in 1 month.
Right. So when you talk about currencies, you can't talk about a currency in isolation like the dollar is stronger. It's always relative to something else. So you've quite rightly articulated that move versus the US dollar is the point of reference. So why is that? Look, there are a few factors afoot. For a start, you've got a US government that is keen to have a weaker US dollar. Part of the reason for that is that a weaker US dollar makes American exports cheaper in the global marketplace.
I didn't know that.
And so, you know, if you're thinking about buying a car and it's or an asset of some description that's priced in US dollars, and the dollar weakens away, net it's going to be cheaper for you to be buying that. So it's helpful for exports, and by contrast, it makes imports more expensive, which in a way is like its own tariff, which again is a deterrent from a balance of trade perspective. So a weaker currency is not always a bad thing.
Okay, so let's draw on this a little bit further, if we may, because there's been so much talk the last year or two about Trump tariffs, of course, and what that means for America. Is the current? So you say that a weaker US dollar is not a bad thing for the US government or the US economy?
Not bad for exports, that's for sure. Yeah.
Okay, is there any way that the administration could influence currency markets, and how so?
I guess, you know, and it's a bigger question. I mean, the hot potato has been, you know, the composition of the Fed, and it's been very clear that President Trump and Jerome Powell haven't been seeing eye to eye. They're not going to be on each other's Christmas.
Definitely not.
And Jerome Powell, of course, retires from his position as Fed chair in May of this year. And there's the ability to stay on as a Fed board member for, I think it's 12 months or 14 months thereafter. So replacement coming in, new guy was announced just recently. And
Kevin Walsh is the nominee.
Yeah, and I think markets are still, and it's still to be confirmed, I think, but that's the nomination. So markets are taking a little time to look at this because typically speaking, he's probably in favor of slightly firmer rates.
It was a hawkish call as far as I understood, which could mean more interest rate hikes.
And so, it leaves him the potential to be at loggerheads with a president that would like to see lower interest rates. And the reason, I think, from a US government perspective, why they want lower interest rates, number one, it's a freer economy. When you've got lower interest rates, there's more money flowing flowing around rather than being sucked out. It's a stimulant. The danger of that, of course, is that it has a potential to be inflationary, as we've seen here in Australia. We'll get onto Australia shortly. Secondly, lower interest rates is also underpinning a weaker US dollar as well. If you have firmer interest rates, you typically see a firmer currency on the back of it too.
So to add to this, we recently, at the time of this recording, had some inflation data come out just last week. So the producer price index, which I know you love as a leading indicator for CPI, came in well above expectations, both on a month-on-month basis and a year-on-year basis. Higher inflation, potentially higher interest rates with a hawkish Fed governor coming through the door. What does that then mean for the future of the US dollar?
Well, if you see the response from the Fed is to move interest rates up to take some of that speculative heat out of the economy, that net is going to result in a higher exchange rate, firmer US dollar on the back of higher interest rates. I think the other reason for wanting to see the opposite from a President Trump perspective, managing the economy, is that the borrowing costs become lower, yields on bonds become lower in a lower interest rate environment. So the cost of funding any debt, whether that's corporate debt or whether it's government debt, which obviously is a significant thing for the US. If you've got to refinance at lower levels, that's not a bad thing because you obviously save money. It's like refinancing on a property when rates are cut. So, it's going to be a very, very interesting and no doubt a very truth social driven discussion around where interest rates are likely to go for the US. But I think, the dollar turning to the Aussie dollar's strength by comparison, we're in a situation where, again, at the time of recording, we're looking down the barrel at a very high probability of a rate rise here in Australia, which we've called, pretty well, I think. Part of that is the inflationary bubble that we're dealing with here, which in itself has been created by rampant government spending. There's no question about that. In the US, there's also rampant spending, but it's actually in the private sector in the form of CapEx, for example, and money going into things like data centers, which are a very narrow part of the economy, but the trickle-on effect of that, of employing people, labor costs, raw material requirements, energy requirements, etc., suck that capacity out of the market and cause a level of inflation. So, the other thing helping Australia, of course, has been the resources moves that we've seen, the likes of iron ore and coal being two, but also gold, which has been on an absolute tear.
That's an interesting one. I want to talk about gold a little bit more, both for Australia and the US. So gold, as we know, has had an absolute outstanding run the last year, along with silver, which has been
with silver,
it's just been 200% or so in the last year. Up until Friday last week, we saw a 30% decline in silver prices in one day, worst day we've ever seen for silver, and about a 10% decline in gold prices. How does that influence the Aussie dollar and the US dollar?
Look, I mean, I don't think there's the direct relationship there is quite the same. A lot of people have been buying gold for a variety of different reasons. If I go back to March last year, I was looking at buying some physical gold and didn't quite get around to it. I wish I had. The reality is, a lot of uncertainty within the global economy often sees people want to hoard what they would consider to be safe haven assets, and gold is traditionally exactly that. Not so good because people often talk about gold as an inflation hedge. Bear in mind, gold is priced in US dollars, so if you see a stabilization in its price but a weaker US dollar, net it's losing its value to an extent. If you've got if you're holding it as an outright commodity. All right, if you've got to convert it back to Aussie, of course, in our case. So there's a little bit of a swing to the upside. Similarly with silver, I mean, silver has always been a much more speculative instrument. And I'd say to anybody other than doing physical bullion, if you're ever trading silver, never do futures, always do options on it, because with futures, it's a wild ride.
SLV is the ETF code. We trade that extensively.
Excuse me.
That's okay. We trade that extensively through both our advanced options and cash flow on demand portfolios. It's a great asset to trade. We've made so much money on it.
Look, it's a great trading asset. Again, it's understanding that there are different ways of approaching assets to ensure that you don't find yourself in a situation with silver that it's lock limit down on the futures exchange. So you can't trade again that session because it's hit its lock limit down, and it opens up the next day and gaps again. You lock limit down the second day, so you're just sitting on a pineapple. It's not much fun.
Well, worst day ever for silver on Friday, 30%.
It is, and it's not unexpected because when you see the tit-a-tat of the gossip, everyone has got a view, and I see this firsthand, obviously, with a reasonable profile on social media. And people go, why would you listen to these clowns? Just buy silver. And when it becomes such a a mainstream indoctrination that is the only form of asset class you can go in, you're starting to move into a genuine speculative bubble. If we were to turn the clock back 8 to 10 months, you'd argue that the same conversation was being had around Bitcoin. I haven't heard anything out of those guys for a little while because they've been on the wrong end of an absolute shellacking as well. So when you start to see those conversation points kick in, it's I'm not going to say it's the death roll that you for that particular instrument, but oftentimes it can really correlate with that sort of speculative high. And as an aside, one little project I'm working on outside I've sort of alluded to previously, which is in that hedge fund space. One of the tools that we're developing in the armory, if you will, of when to buy protection and risk management is the ability to use AI to social media scrape to actually go, man, everyone is talking about this now. And if you look at that on a speculative bubble perspective, it's actually pretty damn accurate.
Interesting.
Yeah.
Speaking of speculation and risk, Aussie dollar is typically treated by the global stage as a riskier currency.
Very much so, yeah.
If it's a good proxy for risk appetite, so to speak, and we've seen the Aussie dollar rise, does that mean investors now are willing to take more of a punt, so to speak?
Yeah, I think to an extent, yeah. I mean, we've seen the resources boom go on, and I mean this sort of conflicts to an extent with what our outlook is, for the Aussie economy. I mean, we've actually got quite a neutral to sketchy, bearish outlook overall for the Australian economy. And I think if we see an interest rate rise in the immediate future from where we're recording today, that's likely to be a catalyst to speed that up for a number of reasons. So if we consider our iron ore exporters, iron ore is priced in US dollars, so a weaker US dollar is not so good for them in terms of the revenue line, and the cost base is in Aussie dollars, so they get a bit of a compression there. But overall demand for those underlying commodities has been pretty firm, which has been driving the engine room of those businesses. Everyone's expecting to see a slowdown in China. It's been talked about, but demand still sits there right now as we speak for those underlying commodities, and that's certainly given those businesses a great boost.
Yeah, it's been a great run for the resource sector. I know running trades on Whitehaven, coal, BHP, Fortescue, Lynas, and Mineral Resources in particular, they've all done extremely well.
Yep.
My question, though, for anyone out there who invests in the US market that lives here in Australia, so you're an Australian, your base currency is in Aussie dollars when you have a broking account. Here comes the hard part of today's discussion, AB.
Are you talking to me directly or asking for my view? Because I'm exclusively in the US at the moment. So.
Yeah, okay. So you're trading US dollars, but you're here in Australia with Aussie dollar account. You want to hedge out the currency risk insofar as limit the amount of impact it has, because if your positions or cash is set in US dollars, eventually it's got to come back to Australian at potentially what would be a lower rate right now. How do you hedge out or mitigate that risk?
The currency hedging is a great tool. And like all tools, it can add value. Like all tools, it typically costs money as well. So it's a terrific value add, but you're going to pay for it. So if you look at the main ways of hedging currency risk, if you're a business, for example, you can do a forward rate. So let's say you're buying some marble from Italy, so it's priced in euros. You can set a price that you pay on delivery down the line based on the spot rate now or thereabouts, so you don't have an unpleasant surprise in 3 or 6 months' time when your marble gets delivered. And all of a sudden it's 30% more expensive. So a lot of businesses that are in the import-export space will use things like a forward rate, and that's more of a business use for it. As an investor, that's not something that you're going to do because it's a clunky, very specific time frame type approach to use. Instead, I think the main sort of tools for investors, number one, ETFs now you can use particularly well to help hedge out currency risk. You can hold various ETFs that are denominated in different exchange rates for a start. And so your currency exposure is limited in that regard. Secondly, you can use options to assist you in protecting a price level to say that, okay, if you feel that 71 is where the Aussie dollar's tapping out and it can only come back, you might buy yourself a 71 put, for example. So if the exchange rate moves and the dollar moves back to 65, you've got that 6 cents of protection in play through buying a put.
Could sell some calls to pay for the put. So
you could put a collar on it. There's a myriad of things you can do in that space. The challenge with all of this is what you're now bringing is an element of timing to a decision that you're already in. So, for example, if you own Apple shares, you bought them, you've paid for them, and the currency may move around a little bit. But as soon as you put that sort of nut and bolt around it, if you were to use a collar or you buy some puts to protect the currency, if that doesn't pan out, that's coming out of your P&L because you've bought that position. And you've got to be minded, all of these things, small as they may seem, add up. So not only have you got to buy the put, so there's the premium you've got to pay, but there's also the transaction fee that sits alongside that. So you want to be pretty confident with your timing if you're going to do that. So over the years, I guess I've looked at it as something that can ebb and flow. And net typically squares itself off. Not always. A good example of this, if we go back in the midst of time to, say, the post-GFC environment, if you look at the Aussie versus the US, where we were typically sitting in a sort of 60, 63 kind of trading range for the Aussie dollar versus US dollar, then all of a sudden the GFC comes along, the US economy is slowing down, and here in Australia, the economic furnace is being topped up with the boom times in the mining sector on the back of all the exports that were then going into China, iron ore, coal, et cetera, et cetera. The Aussie dollar moved up to, I think it's 108, 109 at one point in time. That's a really, really significant move.
Oh, yeah.
And so if you've got a structural view over the economies, one is struggling to deal with the GFC, and the other one in this instance was almost immune to it and getting the follow through of China's boom, that's where you would take a view on the currency anyway, and that's definitely where you would look to see some protection and hedging going in. In the current conditions where, we very likely will have an interest rate rise, which, to be fair, I think is largely factored into the currency already.
Yep.
You're kind of playing catch up on a game that's already finished.
As I said, 12% move has already happened, right?
It's already done. So you've got to be in on the beer the bang with these sorts of things. Secondly, you've also got, as we've discussed, a new chair joining the Fed, who may well be someone that tries to promote a rate rise, which may see a firming of the US dollar anyway. So you're adding another layer of fairly complex analysis to what you've got to do. If you've got money in an account and you're not planning on repatriating it in the next 2-3 years, I wouldn't
just let it sit there. It's funny you say, I look at the expectations or the analysts' expectations of where they see currency for Australia versus the US. Most of the big banks, Macquarie, CBA, NAB, all sit at sort of about 70 cents in the dollar, which is where it sits right now.
Yeah,
so we're already at target.
That's largely, when we're on the wrong end of our hiding, it's been in the low 60s. 70 is somewhere I think is probably fair value. As I say, you look back in history at those times, 108. I remember being in the US at the time. I was getting a coffee at the Beverly Wilshire, which is right at the bottom of Rodeo Drive in Beverly Hills. And normally you get slugged because the exchange rate is woeful. It was like $6 for a coffee, which was about $4.50 Australian. So it was nice to be on. It was nice to be on the right side, as opposed to getting flayed on the wrong side.
What about the euros? I think we've actually gained relative to the euro as well, which is important for both you and I.
Yeah, absolutely. It always helps when you're going over there for a holiday, and
rather than get rinsed at
definitely
50 cents in the dollar.
Yeah, exactly right. It makes all a bit of a difference. But I think just bear in mind, if you try and become overly sophisticated in what you do, you start to have a very, very complex portfolio to manage. And there's a lot of room for things to go wrong, and there are a lot of costs that can start to creep up on you. So if you've got a really clear, definitive view, maybe use some options work. We can assist with that, obviously. If you're less clear on that view, or you're happy just to have the swings and roundabouts, then nothing to worry about.
That's it. AB, thank you very much for the insight today. Appreciate it.
Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.